big event. The 23rd of June, that's when Britons will vote to decide if the UK should leave or stay within the European Union. Polls highlight that the Leave camp is still retaining strong support. Let's listen in to what experts feel the impact of Brexit could be on the markets.
Well, the idea that Brexit does not happen, how will the Cameron government respond? I'm expecting the Cameron government to be, this is a heads up, and I expect them to focus on this anger. And I think the best way to focus on this anger is creating more opportunity. So my belief is the UK has to begin a major fiscal policy expansion, especially in infrastructure.
If they vote to stay, then what we've got uncertainty coming down and status quo. That has got to be good for risk assets overall because it's just a net positive with less uncertainty. If they vote to leave, though, it's really hard to know how markets are going to react because there's been so much negative pressure on sterling, so much negative pressure on global markets. Maybe it's not as big a deal for the global economy as people like Janet Yellen seem to fear. What we could easily see happen is a sort of a sell the rumor, buy the fact, where people wake up the next morning and say, OK, well, maybe we'll be OK here. And all the negativity has been sort of baked into that stage and markets rally. The uncertainty is certainly hurting markets.
Since markets, looking at equities globally, are pretty much where they were about a week ago and really haven't moved down much on this idea of Brexit, we could probably say they're pretty fairly valued now. But there's still a lot of anxiety in markets. You see this in options pricings, for example. In the credit markets, there are players out globally looking to pay very high insurance premiums to guard against the risk of wider credit spreads. And it's very high relative to the actual volatility that is likely to be seen in markets over time.
Okay, so that's the global opinion.